Mell. I'm President CEO of Electra Battery Materials. Our strategy is premised on onshoring the critical mineral supply chain into North America. So Canada, US, and trying to decouple from China with assets that include a core asset being the refinery up in Canada and some mineral assets in the state of Idaho.
Trent, good to see you, sir. Been a while. December 2023, to be precise. So a long time, and a lot has happened, and the world has changed and continues to with Trump tariffs, etc. So, I wanted to give myself a quick reminder of what it is that you do. What is the model now? Are we cobalt refining, battery recycling, nickel sulfate exploration? Where are we at?
Yeah, the core of the business, the first asset is leveraging our refinery. So it's a hydromet refinery. It's displacing that part of the Chinese supply chain by expanding a brownfields asset north of Toronto, starting with cobalt that we're going to source, redirect from the DRC into North America.
Right. And how does that make money at today's prices?
It makes money because we're in a tolling arrangement. We've, because it's not our mine, we're sourcing through ERG and Glencore. We don't need to be market facing. It's nice when the market performs, and I think cobalt might be set for a bit of a rebound. But by and large, single asset getting going, we don't need that exposure. We know what our costs are. We know what the margin opportunity is, and we've locked in a 5-year supply contract with LG on a tolling basis, which provides us the margin that ensures we never go out of business. And in exchange, we're never, kind of overcharge them, if you will, in an exuberant market.
But how do you guarantee that you make a margin on it? Because obviously you've got costs. So where's the margin?
Yeah, it's basically the cost that they pay us to toll the production. So we buy the hydroxide from Glencore, say, we bring it in. We know our cost structure. We're targeting a certain number of dollars per pound. It works out to about a $30 million US EBITDA margin per annum once we're fully ramped up to 6,500 tons. And we just want to play that out. We got mining assets where you can, get that volatility and that exposure to the upside of the market. But for this one, it's just steady Eddie, be a multiple of EBITDA. Refining assets can be anywhere from 6 to 12 times, depending where you are in the cycle. And so that's really the name of the game. We've had too many peers. Look, we're all hurting. All the pre-revenue companies are down 70, 80, 90%. We've had peers around us that have gone bankrupt. My goal is to be the very first critical minerals asset in Canada to get delivered in 8 years. And I think this business model will prove to be resilient as we get there.
Is the market still there for it? I.e., in terms of the thematic was big and strong, 21, 22. Is the market still there for you? Is there demand for it?
Yeah, Trump. If you want to look on the policy side, Trump 1.0 to Biden to 2.0, the journey is the same, right? It's about onshoring, and it's about again decoupling from the dominance that we know China has over that supply chain. And so one administration was focused on carbon footprint and EV transition. The other, it's about national security and defense. We do have great support from DoD funding and an ongoing dialogue. So yeah, the narrative still works in the policy side. Look, the demand side has, the trajectory, if you will, of growth in North America has come down, but it's still growing, right? We got to remember that it's still positive, it's still increasing, and will be one of a kind. Nobody's doing what we're doing. There is zero production of cobalt in North America today for batteries. 12x growth rate on defense applications as well. So let's not forget that. Everywhere from drones to anything battery operated radios and night vision goggles and everything that a soldier needs. So yeah, the demand is still there. People get lost in the headlines of, growth coming down, but I think we're past the tipping point. It'll just take a little bit longer for North American EV penetration to catch up to Europe and the rest of the world.
Okay, well let's talk about the journey, because obviously I think you have that kind of, I'm going to say, first mover advantage. You and not so many other people. 21, 22, people got excited. Your share price got excited. Obviously, it's been moving a lot slower than perhaps you would want and your shareholders would want. A few more competitors out there. So maybe talk about that landscape and what precisely you're targeting.
Yeah, from an operating basis, I look at where we would sit on the cost curve. We're somewhere in the middle, maybe trending towards the third quartile. But that's against Chinese producers. Right? A lot of swing producers in China that in a rational market won't make money. So we feel good, at least when we're facing the LGs of the world and GM and Tesla and whoever the client may be. That we're not a high-cost producer. The challenge is CapEx. And the Asians learned that as well, right? Building battery plants on this side of the world, things are costing 2-3 times or more than they would cost in Asia. And so where we, got ourselves on our heels was starting construction post-COVID. The world was upside down. Supply chains were a mess. Inflation was on a spike. And that's where we started our construction. So in order to get back to action, the market wants to see government pick its winners. And so I've always said, once we get the government piece lined up, we've got the market players, strategic and otherwise, that'll come in and backfill. And so we announced DoD for a 20 million US grant last year. We announced an LOI with the Canadian government, 20 million Canadian. But a couple of months ago, we've got one more piece that we're pursuing and a strategic. So once I get all of that, the rest will fall into place. This is not a big build. It's 80 million US to get ourselves to operation. So in contrast to a mine operation or a cell plant, these are small dollars, but the government's got to go first.
Right. And what are they attracted to? Because you start off as an explorer, then you kind of came up with this kind of integrated, vertically integrated strategy. We kind of feed into specific markets, OEMs, whatever. Now DoD what's the total achievable in a market for you guys? What are you looking to address?
It starts with, so there's a couple of ways to look at it. Once you get going in refining a hydrometallurgical refinery, you're taking materials in the front door and you're leaching it, and then you're going through a separation and a purification step. You can do that with nickel or manganese, or in our case, battery black mass. And so there's a lot of scope to grow there. We got to get across the first revenue stream. We do have assets in Idaho, right, that are upstream. I discounted them a little bit because of the relative grade and the scale of some of the mines in the DRC with CMOC and others. But Trump's made it very clear publicly, and his administration has made it very clear privately that they do not want America to rely on Chinese-made critical minerals, whether it be in components or directed source. So I think there is a bid now in Idaho that probably hasn't been there for a few years. Most of the money for critical minerals now going through DoD, some $7 billion. MP Materials, not to overstate it, but that's a perfect example. Where are they? They're in the midstream. They're mining, and they're in the midstream, much like us. And so, I'm not saying we're going to pull that rabbit out of the hat overnight, but it does show an appetite to solve problems. And if you look at the DoD priorities, I think 40% of monies up until that point were directed at rare earth projects, followed only in number 2 by cobalt at 20% of their funding. And so we are an important priority. We've got regular dialogue throughout the administration. I think there's a lot to be said about being the first, and for a while perhaps the only, cobalt producer. So the appeal right now for government is its strategic value. That let's go back to where we got the money from. Defense Production Act is a Korea War era instrument that allowed DoD to invest extraterritorially. Why? Because America found itself in Korea and it didn't have the munitions and the weapon systems that it needed to defend itself. So Canada for aluminum and iron ore and copper and nickel. And that's kind of the mindset, right? That the warrior, as we call it, that fabled sort of construct of what we need to be ready for an emergency, it's going to need cobalt, and it's going to need rare earths, and we're going to need all kinds of, and this is where the money has shifted, because that's really where the priority of this administration is. And so for Electra, it doesn't change the strategy, right? We've got to onshore these assets, and the refining piece is a very addressable one because it's not contingent on geology.
But is there a bit of you that's like nervous about being reliant on government contracts, because they'll move at their own speed, and so there's a lot of people clamoring for that cash? How do you kind of take control of the situation? You've got various agreements with I think you said Glencore and ERG and Aki and so forth. So you're trying to construct something, but what are the other kind of defensible actions that you're taking?
Yeah, we've got another piece to land here shortly, but the government pieces are there, and that's going to get that cobalt asset to production. Future growth,
being the Canadian government you're talking about.
Canadian
right.
And the U.S. government, right? The DoD is actually funding the Canadian asset, which is kind of neat, right? And it speaks to the importance of what we're doing. Future
so
growth.
Trent, can you clarify that? Because obviously you've had some funding, DoD, which is the US government, and then the Canadian government. You obviously change of government, etc. Will everything continue to run as anticipated with the new government in place?
Yeah. To be very clear, the money that we have announced from DoD and the Canadian government, there's been no change of appetite. Trade war, change of government. I think this kind of transcends all of that, and that's noise. We keep our head down. I don't need or want to get involved in politics. What we're doing is identify it as a strategic priority for whatever government happens to be in power, And so to your point, yeah, that doesn't fall away. I think the commercial strategy, important to underscore, is not contingent on government contracts, right? We've got our product, most of it's sold to LG Energy Solution, and so there's no expectation. I'd like it. I'd love to stockpile or sell to the U.S. government or defense agencies, but right now the idea is, here's the money, get it built, so if we ever need it, it's there. What you do with it, feed in and feed out, entirely up to Electra. Government's not gonna meddle. The reason I point to MP is because I think there are bigger ambitions to do big things fast, and so if we could, prove ourselves through this first execution, I think there's a lot more that Electra could do for North America to help develop in nickel and in recycling and in mining in America.
Right. Okay. So let's be clear. You got a 5-year supply. Can you give me numbers on that? And and how does that map to the kind of addressable copper sulfate market that you're looking at?
Sure. Yeah. So 5,000 tons is the first run rate as we commission, expanding to 6,500 tons in years 3. So that's about a million EVs per year, depending on your assumptions and battery size and vehicle size, which of course is bigger here in North America. That feed's going to come from ERG and Glencore, so feed that would otherwise go to China now comes this way, which I think helps them as well in terms of diversifying their offtakes. And then the product out, we've got at our election a minimum of 60% of our production for the first 5 years goes to LG. At our election, we can push that up to 80%. And the thinking there is like LG can absorb it, but Electra, if you can get a better price somewhere else, we'll stand down and you can sell it to that counterparty. So it's nice flexibility to allow us to either clip a better margin or just leave it all with them. And our book today is roughly 2x our production. So we've got 12 to 15,000 tons of cobalt contained that nominally, at least on paper, are of interest to buyers around the world.
Okay, so, and come back, because I just want a bit more clarity on the kind of the tolling fees, right? So that is a kind of set number, or does that change if cobalt price is going to run? Are you a beneficiary of that?
The remainder of our book is still debatable, right? We may want to be market facing once you cover your fixed costs. If you get a constructive view, sure, do that, and I think we all benefit as shareholders and stakeholders. The LG, there's a little bit of nuance. I think the point we made to them early on is, as a supplier here in North America, you never want us going out of business. And they said, no, we never want you going out of business. And so that kind of sets a bit of a floor price. Now that floor price does move. We've got two big reagents, of which they moved around a lot post-COVID. One is caustic soda, the other is sulfuric acid. So we do have a bit of an arrangement with them that if things do spike again, our floor price may need to adjust. So there are some hardship provisions. There is a little bit of participation on the upside, the way you price it. Cobalt reference prices is a hydroxide you buy, and then you're either selling on a metal basis or on a sulfate basis. So there is some kind of triangulation that, without getting into detail, might allow us to benefit a little bit, but it's not a direct correlation to the cobalt price. It's pay the bills, again, EBITDA multiple, be a widget factory with a little bit of upside as you mature your operation.
Okay, so this is about efficiently processing whatever comes through the gate. So there's no kind of blue sky here. So I mean, so when you sort of refer to Idaho earlier and say, well, perhaps the grades aren't what they need to be, the expansion of the blue sky is not going to come from that. Where is it going to come from? How do you scale this thing up? Do you license?
Right. If you're sourcing material from your own mines, you've got that vertical integration, and you do have better exposure to the market. And so, illustratively, Iron Creek, if we were to mine that in the current environment, produce 1,500, 2,000 tons of cobalt contained per annum. Our refinery's big, right? 6,500 tons. So you could see a duality here where you're buying hydroxide, say from Glencore or ERG, you're bringing feed in from Idaho, and you do get that torque or that market exposure should you want to lock in.
But you don't want to do that in a market like this where you have to go and raise like large capex to get.
No, you got debt. I mean, the lenders have been great, but we got debt. We still have, we still got to ramp up working capital needs that LG is actually going to be, I guess, instrumental in helping with. So I think until the ship is steadied and the balance sheet is stronger, I just think you just want to make money. If you get greedy, especially as a junior, you get greedy, you're going to get burned, and we've seen it, right? I won't name names, you know who they are, but you don't want to go there. It's a hubris to think that you can compete toe to toe with China, and I want to avoid that until we're good and ready, and the rules of the game have been redefined.
Well, okay, but in a meaningful way, you kind of don't care what's happening out of China because because I'm not quite sure. Your cobalt's coming from Africa, right? DRC, right? Okay, so Chinese export restrictions or Chinese squeeze on price, it makes no difference to you. You don't see any of the upside, and presumably it's not going to hurt you too much on the downside as long as it's going through, right?
The DRC feed, for the most part, is going to China today. So if you had an export restriction in the nature that we saw for rare earths, it would have the same impact on the cobalt market. There would be a scramble. Or last week's announcement on graphite tariffs, for similar reasons, right, to try to decouple. Even though we're mining it in the DRC, the majority of that supply chain is dominated by either Chinese miners or at the next stage of the midstream with Chinese refiners processing that material on behalf of Glencore, ERG, and others.
So so your contract with Glencore, so they got the option to not supply you in there? What would happen if they didn't supply
No,
you?
well, we've got a what is the contract with them? I think it's a 5-year contract, if I recall. Like
Yeah.
1's 5. So no, I mean, think of it as diverting feed away from China. Feed otherwise go to China is now coming to North America. So it gives them different exposure to different clients. It's a Western market, Western offtake. And I would add, we got the Glencore smelter, right, in Sudbury nearby. We got the Horn smelter in Quebec. So we got a couple of smelters nearby. So there's some other synergies that we may get at the margin, acid and things like that, contractors. So it's I won't say it's a cozy relationship, but there's some potential synergies downstream as well.
Okay. Well, yeah. Okay. Can we talk about some of the other options available to you? So obviously, it makes sense to steady the ship, to get to a point where this funding is in place, and maybe get this thing built, and start processing, and spitting out cobalt, the other side. But the scale probably is the thing that people are looking at and say, well, like, how does this thing scale? I get the steady the ship, cash in the bank, it's nice, and it may give you optionality on, maybe Idaho. I don't know how you want to play that, but what are people going to buying into in terms of how does this thing grow? Where's the growth?
Yeah, look, I think in the shorter term, it's just the multiple, right? If you're trading at 1 times and you've got a market that's at 8, you've got a natural re-rate just in de-risking the asset, bringing it to production. The re-rate for us, once you've got this asset, call it $250 million or so of replacement value, infrastructure, lab, people, tails, water pipeline, hydropower, recycling is the next likely phase of growth. And so we got the two pieces, right? We've got joint venture with an Indigenous Economic Development Group under a company called ACCI, and that does the battery collection and shredding. And then that black mass under an evergreen contract comes to the refinery for processing and particularly recovery of lithium, nickel, and cobalt, amongst the other minerals that are there. So that's the next piece. ACCI sits off our balance sheet. They're sourcing the capital to build the shredding plant, and then we would have to build out the refinery piece for the black mass and do the recovery. So that again is premised on more of a tolling model where you're taking material from battery manufacturers. So rather than be collecting batteries from everybody's backyards, you've got a steady source from cell plants that actually have a lot of scrap, right? We're talking 10% scrap rates. So that's the same stuff every day, and you return it to them under a toll model. So again, for the audience here, the resource investor that wants to swing for the 10 bagger on an outperformance of gold or uranium or whatever the commodity, you're only going to get that really out of Idaho. Here you're going to get a reliable, we're not quite steady as a bank earnings, but our utility, but we're trending more that way than maybe the miners. And I think there's sort of horses for courses. The mining piece gets interesting, but I think the refinery, given the exclusive market that we are in, a class of 1 for cobalt, gives you a measure of comfort and maybe even pricing power, depending how global policy here works out on critical minerals.
Well, when you say class of 1 in where you are,
yeah.
Right? No, with cobalt in Canada, but what about some of these other kind of U.S. players as well?
There are other development stories.
Yeah.
And look, everybody's working hard. We'll be the first to production, and I say I don't see any asset in Canada, for instance, that's going to get to operation before we can. Like we're talking 15 months of construction, then you're commissioning, right? Once we press go. And so a lot of these assets in the U.S., including our peers, are a little bit further behind. So I think we're in relatively speaking, very good position.
Okay, and so and again, I want to be clear on the model here. You're saying there's going to steady as we go. The tolling model also on the recycling is something that you're comfortable with, yeah?
I am comfortable with, and if you think you start getting that operating experience and that credibility and that revenue base, it puts you. I'm going to go back to MP. Sorry to ride that horse again, but if you can become a trusted supplier to the U.S. government or to the U.S. industrial base, it puts you in a good position for growth, capital, and leverage. And I haven't changed my tune on this. The reality is growth projects, you're going to have to lead with government money, right? And so whether that's DOD or whether that's Exim Bank or other tools that are being developed, I think that first money in, particularly in the U.S. right now, it's going to be strategic. And so you got to be close to Washington, you got to be close to the different departments, and you got to have your ear to the ground. And so I spend personally a lot of my time just conversing with U.S. officials to try to make sure that we are relevant, helpful, and in the know.
Okay, and in terms of the technology on the recycling, where are you with with proving that? Where are you with kind of economic studies? So I should understand. Can you make money from it? And I guess ultimately, commercial customers, have they signed any MOUs, LOIs? What are the names?
Yeah, so the can you make money is the important one, because we're seeing that in the black mass shredding, right? Black mass is being bid up. The price of black mass is being bid up by Asian suppliers. So if you're trying to get the battery scrap or get your hands on the black mass, a lot of that's finding its way to Korea or indirectly into China. And that tap will close eventually. We don't yet have the refining capabilities. So the commercial piece, that's why, again, not to go head to head with China. If you can get a toll arrangement with a cell producer, say we'll take PowerCo in Southern Ontario, you could take their scrap and return it to them as critical minerals for a fee. You're not in a noisy landscape of offshore people and traders trying to send it off to a land where you never see it again, right? And we work so hard to onshore. It's the big back door going out the barn of all the critical minerals we fought to get here. So, but let me go to the the technology side. On the shredding side, it's fairly well established now. There have been enough shredders out there that have developed equipment. There are vendors. We're not going to reinvent the wheel. I think we've done a lot of diligence visits, and I think we've got our preferred supplier that we are working with. CapEx is not overly intense. Margins are not great on the shredding, I'll be honest today, but that's why the partnership's important. The refining is where we do have some IP. We spent a bit of time. We've got a $5 million grant from the government of Canada now to kind of take it to the next stage. We made a technical grade lithium. We've recovered high purity nickel, cobalt, graphite's there. It's not worth a lot of money. A little bit of copper. So we've got a flow sheet. We're going from a plant scale demonstration plant. So we used our existing refinery, reactivated the legacy plant to run the demo. Now we've got to go to a continuous basis. So scale it up, cost that out. So we're kind of halfway through that. And we've got, I would say, on the commercial side, we are more engaged right now on strategic partners to invest in that build than we are in the feedstock. A lot of the plants that we're talking to that are near Aki, that's really more of an indigenous-led discussion. The conversations are there, but I think until we've got, a detailed feasibility study and the engineering plan, that's going to be hard to lock in a contract.
And with Aki, I mean, and he's holding who up at this point? Aki presumably going to get money from Canadian government. Have they got the skills necessary and the technology necessary to do what they need to do? And how do you slip into that? And what's that agreement between you? What does the
If
JV
you
look
think
like?
of the relative advantages or what each party can bring to the table, Three Fires Group, our Indigenous partner, they are best positioned to source capital that we can't source. And they're in the best position to secure land because these plants are being built on their traditional territory. And then for the battery cell manufacturers, it solves a problem for them as well, right? In terms of Indigenous engagement and license to operate, to be able to work with us. So that piece sits on that side of the equation. And then on our side, we come in with the commercial relationships, the technical expertise. We can build, train, operate, and of course, take the black mass into our facility. And so we got a team member here that meets on a very regular basis, weekly or twice weekly, with the Three Fires Group. So things are advancing nicely. We've done about as much as we could on a desktop or scoping study level, and now we're at a point where we need that funding. We need that $1 million or $2 million to go and do the feasibility study and find the land and start locking in some of those contracts. I'd anticipate we'll have some news on that before the end of the year. We still got 6 months. I think that's ample time given the inroads that we've made thus far with government.
Okay, and so I'm just on the bit on MAUs, LOIs, etc. So just be clear with me. Have you started that process, and what sort of names are you talking to?
Yeah, hard to name names. Yes, we started the process. We look, on the one hand, we get shown scrap all the time. My commercial team gets called. And you got a quiet recall of some batteries, and you got scrap, and I got this many tons, and can you take them? We can't. We're not yet there. I think the real prize would be to lock in a contract with the cell plant directly. Those conversations are there. I think there's one in particular. May not be hard to guess, but there's one in particular that's going. It's going well, right? Everybody's keeping everybody warm, but it's kind of let us know. We've got to design a plant for their module and pack sizes. They've got to know like when are you going to be SOP, start of production, and what your capacity is going to be. So there's a bit of that dance going on, and I think the money's got to come in first. Let's do the detailed engineering, and then those conversations will go in quiet. So I think what you'll see first, Matt, will be some funding and a feasibility study. And I don't know if the strategic funding partner comes in even before the commercial contract. Hard to know how to sequence these things.
Yeah, it's tough. Just okay. We talked a lot about kind of cobalt sulfate and the black masses. I think last time when we talked admittedly it was a while ago. Nickel sulfate was in discussion. Was that still in play?
It is. We had a pretty good discussion under the last administration with the DOE about a nickel sulfate plant that would be built somewhere in the U.S. And we went through a funding program that could have yielded $200 or $300 million towards a plant that would have been more than twice that. And so we lined up some MOUs from some downstream players. We did. I don't think we got the equivalent of a pre-fees, but we got sort of well down the path. We were looking at a similar model, importing nickel stock MHP. Again, you can guess where that might come from, and doing that same kind of toll model. So a lot of interest because it's the bottleneck for PCAM onshoring. And where we got to in the process was neither a yes or a no. It was, it needs a little more work to season, a little more time, but we like the project come back to us when you're more advanced. Now, different administration, different policy tools, so we've got to rethink that. But I'm actually, I'm in discussion still. I'm going to be seeing the state officials just to keep that alive. That's a little bit further down the line. It's a big spend. Will have to be a club deal to make that happen.
What are you doing for that, right? Because these guys want votes, they want to look smart. What are you doing for them in terms of job creation or revenues, tax, etc.? Why should they? There's a lot of people asking for money. So why are you?
And there was a lot. We know under IRA there were a lot of investments that ended up going to red states, right? South Carolina in particular, and so there was a bit of a jump ball for all the other states that didn't get any or didn't get as much to try to get in on the action. These are big spends, right? When you're talking $500 million or more of investments. So the job creation, both there and the regular flows, you need the right permitting jurisdiction, right? If you're going to have a tailings environment, you're going to have water consumption, and this kind of an industrial plant's not for every community. But there are a number of states, and it's particularly in the south, as you go to southern U.S., that are very keen to see the kinds of jobs and investments this could represent. A nickel plant, probably talking a couple of hundred jobs and not a couple of thousand, but still meaningful contributor. And you're pulling on a port, you're pulling on reagents and a lot of contractors, and so the ripple effects in the economy can be pretty significant if you pick the right county.
Okay. Can you just again, obviously want to sum up here a little bit, but just in terms of that financing stack, can you just remind me what money's been raised to date? Maybe I'm not so concerned about the kind of equity, sustaining equity, keep the company going. I'm talking about the funding for the cobalt refinery, and also, I guess, looking forward with Aki, et cetera, on the recycling. What's missing? Where's it going to come from?
Yeah, so on the funding side, we've announced for the cobalt plant $34 million US of government contributions to governments. I've got another piece that's not yet daylighted that will come to pass. I've got a strategic investor term sheet for 20. So I would expect to, when all these pieces come together, we'll probably raise another 20 just to cover the working capital and ramp up and first bills. So, but again, we got to get that last government piece because it'll really help de-risk. So that will come to pass you know, I got to stop predicting when because
Yeah,
government.
no, because it sounds like a
But
religious
we're like
statement.
I'm feeling good. I'm tired and it's taken too long, but we're in good shape. The Aki piece, look, I think it's small money right now, right? It's study money, it's feasibility money, and so that's a couple of $1 million for 6 months time, and that will help advance some of these corporate and trader talks on financing the capital. But look, Frank, we've got a lot of ways that this can go, right? With policies and with government funding and lateral and vertical integration opportunities, but it all comes down to the cobalt plant, right? Get the money, build it, deliver, and then you can go from there.
Do you feel that obviously, like it's been pretty crappy markets the last 3 4 years for juniors, explorers? You know that more than well as anyone. But even for projects like this, where you're trying to create something a bit more conventional, industrial, right? And that has certain multiples, but it also has, as you say, slightly more conservative growth profile, but very attractive nevertheless, right? There's a steady assuredness to it once it gets going. There's a very different financing environment out there at the moment, and you happen to be quite creative. I mean, did you look at alternatives to government funding? Was it there? Because there was a lot of chat over the last 3 4 years, ESG, green funds, etc. What did you find? What was your experience?
Yeah, the ESG Green Fund, that sort of new money, new world of money, they want bigger tickets, right? They want to write $100 million or more, or they want more mature assets. So we're a bit of the redhead stepchild. Definitely take the call, definitely interested. You're too small. You're too small for us. And it's frustrating. We should have built something a lot bigger, or maybe 3 plants. Um, Government really is where we landed, where it had to go. We have our lenders have been great. We got 3 lenders. We got convertible debt. They've been eminently supportable. I think we're in a world where strategics and institutions they need a winner, right? Like when graphite went on a run a few days ago, or when LFP technology ban kicked in, you saw Nano One tick up. You look at the chart of a few of us, more in the midstream. We came for the ride. We were up 18% on both of those pieces of news at MP, I suppose. But company specific or industry specific events are driving a lot of trading. Um, and I think if we again, we're a news announcement away, right, from getting that re-rip. We are down more than I care to admit. But it's a toggle. Yeah, does Electra get funded or they don't? If they do, this will be a fun ride. I got a nice, I'm feeling pretty good, but for the time that it's taken to get there.
But for the time it's taken to get there. Well, like I think the trick is to get there, stay in the game, to
Yep.
play the game. So, Trent, like appreciate that kind of run through, and especially understanding the model. I know what I'm getting into, if I was to invest in you. So appreciate that. You made the time to see us today. Stay in touch. Stay in touch. It's a coming.
Yeah, it is. It is. Yeah. Wait for the next update.